Tony Dwyer, Chief Market Strategist at Canaccord Genuity. Tony, it's great to have you back on the show here. I do want to start with, the Dow eked out a small gain today, but the S&P and NASDAQ finishing the day lower again. You had been on CNBC, late December, and you had said we were prone for a pullback. Is that what we're getting right now?
Yeah, really coming into this week, the note I wrote, and thanks for having me, Morgan, and Happy New Year to you and John and all the viewers, of course. So coming into this year, we called the first note of the year opposite day. When you look back at October 27th, you came into the market with rates spiking to 5%, with the S&P historically oversold, with the VIX historically oversold. Or overbought, sorry. And the dollar was very strong. And it is absolutely opposite coming into this year from that scenario. So the market is right. It's very positive historically to have the kind of breadth move that we've had that came with the Fed pivot, dovish pivot last year. But all the data that we have suggests it just got too extreme.
What are your thoughts on Treasury yields as we do see the 10-year back at 4% now?
So the technical side of it would suggest a bounce. Like as I said, Morgan, like if you looked at the weekly stochastic, I call it my trusty weekly stochastic, when we look away from the macro or the fundamental data, and any move, what's been amazing to me is how extreme the moves have become and how quickly they become extreme. So you've gone from an extreme overbought when interest rates on the 10-year got up to 5%, now down at 3 3/4, it got extreme to the bottom side. So it suggests a bounce. Coming into this year, you had the market anticipating 7 rate cuts. When we were talking about more, we called it higher for shorter. When rate expectations coming into October were for only maybe 3 cuts this year, it's 7 cuts. You're kind of I don't know what data you're going to come out with this month that's going to make yields go down. So I think that was the setup for a bump higher in yields here.
Okay, so overall, the stage is set for a pullback, and we're getting a pullback. But what about sectors? Do you rotate into something, out of something? Healthcare seems to have been performing particularly well thus far in the first hours of 2024 compared to 23.
Yeah, John, it's the inverse of what started last year. You take all the prior year's losers and you ramp them in the beginning of the year. And that's kind of what healthcare, small cap, equal weighted over S&P. And I do think that'll be a more prolonged theme. But that's where you go first, is you go to the most oversold areas that you can get the lift out of. And I think that's what the market's done. When I look at the small cap or equal weight, when I got into the business in 1987, not to date myself too old, the debate was you can't use the Dow Jones Industrial Average anymore because it's just 30 stocks. So portfolio managers and institutional investors, pension plans, they transitioned to using the S&P 500 because it was a more broad representation. Well, today, those top 10 stocks of the S&P 500 are a third of the market, literally 33% of the market. So when I talk about the market, I talk about the more of an equal weighted S&P or small versus large. And I think both of those are going to outperform for, I think, years to come, potentially, not just over the next, because it's coming into this year like that, John.
So along those lines, then, for 2024, what does a balanced portfolio mean, whether you're including fixed income, whether you're talking sectors, or whether you're just not relying on just an index and index funds to be safe?
Well, the issue that has come into the market is it's structurally different, because it used to be if you're coming out of bonds, you've got 2 options, stocks and cash. Well, as you guys know, that has changed dramatically. Not only is it that, usually it goes into passive, but now you have the option of private, whether it's private credit, private equity. So when I talk to investment committees of endowment funds or pension plans, they're not talking about, okay, let me go find the best fund manager out there for domestic equities. They're talking about how to get into private credit or increase or add to their exposure in private equity and venture. And those locked up investments, I think, is what's helping create some of the volatility and the asset allocation shifts that we've seen over the last, maybe 5 years.